let's take a trip. I want you to stand with me on the stone arches of the Ponte Vecchio in Florence. The year is 1300. Beneath your feet, the Arno River isn't just water. It's a swirling slurry of industrial runoff, dyed violent shades of red, blue, and green. Now, take a breath. The air doesn't smell like an Italian vacation. It reeks of sulfur, urine, and wet wool. You are watching a mule train plod across the bridge. It looks utterly primitive. You see mud-spattered men, exhausted animals, and bales of raw, dirty fleece that were sheared from sheep in the rain-soaked hills of the English Cotswolds. To the untrained eye, this is just dirty cargo. But to the forensic historian, what you are witnessing is a technological miracle. That wool has traversed 1,200 miles of hostile territory. It crossed the English Channel, navigated the freezing peaks of the Alps, and survived the bandit-infested roads of Lombardy. And it did all of this without a single internal combustion engine, without a telegraph to signal its arrival, and without a centralized police force to protect it. Yet, the transaction you are watching right now is valued at a sum that exceeds the lifetime earnings of 1,000 peasants. How is that possible? Because invisible to the naked eye, there is a web of data surrounding that mule train. Letters of credit, marine insurance contracts, notarized bills of lading, and double-entry ledgers are guiding that cargo with the precision of a GPS satellite. We are looking at the autopsy of the system that invented modern capitalism. We are standing at ground zero of the global economy. By the time we finish this deep dive, you will understand a terrifying truth. Your Amazon Prime delivery network, your cold storage cryptocurrency wallet, and the quarterly earnings report of every S&P 500 company are all genetic descendants of innovations built by Florentine wool merchants who have been dead for 7 centuries. And more importantly, you will see that every single systemic failure they suffered, from liquidity crunches to contagion events, is repeating in our markets right now. The code was written in 1300. We are just running it on faster hardware. This gets dark. And then it gets profitable. Let's break it down. The scale. The Silicon Valley of the 14th century. To really grasp the magnitude of this machine, we have to look at the demographics. In the year 1200, Florence was a respectable but unremarkable town of about 50,000 souls. Fast forward just 1 century to 1300, and the population has detonated. There are 120,000 people packed inside the city walls, making it a metropolis larger than London or Paris at the time. But the real scale is in the periphery. Another 300,000 people live in the surrounding contado, creating a dense, integrated economic zone. Italy, at this moment, becomes an anomaly in human history. It is the most urbanized society on the planet, with 20% of its population living in cities. For context, most of Europe was 95% agrarian subsistence farmers. These Florentines weren't growing wheat. They were processing data and material. At the center of this explosion sits the Arte della Lana, the Wool Guild. Now, don't think of this as a simple trade union. It was a state within a state. The guild directly employed 30,000 workers. Think about that ratio for a second. One single industry was putting food on the table for 1/3 of the city's entire population. They were outputting 100,000 bolts of cloth annually, enough to clothe entire armies. But here is the supply chain revolution that makes this relevant to the modern CEO. Tuscany is actually terrible for sheep. The local wool is coarse, scratchy, and practically worthless for luxury markets. So, Florence did something unprecedented. They built an economy entirely on imported raw materials. The high-grade wool came from monasteries in England and Spain. The alum, the critical chemical fixative for dyeing, was shipped from mines in the Levant, modern-day Turkey and Syria. The dyes themselves, indigo, madder, kermes, were sourced from global trade routes reaching deep into Asia. The finished product was then exported back out to markets in France, Flanders, and North Africa. This is globalized production 1.0. It was organized through a system called the verlag system, or putting out system. Wealthy merchant firms didn't build massive factories. Instead, they bought the raw material and contracted it out to a distributed network of independent laborers. The washers worked by the river, the spinners worked in their cottages, the weavers worked in rented sheds, the dyers worked in specialized toxic districts. This should sound hauntingly familiar. It is the architectural blueprint for the modern gig economy and the distributed manufacturing model of companies like Nike or Apple. Design in California, Florence, source materials from 12 different countries, assemble in Vietnam, the Florentine countryside, and sell to the world. Same pattern, different century. And the fuel for this engine? It wasn't coal, it was tax revenue. The entire Florentine Republic survived on the arbitrary fees levied on this flow. Import tariffs on raw wool, excise taxes on finished cloth, export duties at the gates. The prosperity of the wool merchant wasn't just a private matter, it was a matter of national security. When the trade stopped, the soldiers didn't get paid. The math was binary and brutal. When the supply chain functions, civilization holds. When it breaks, the city burns. Innovation 1. The Ledger of Reality. Double-entry bookkeeping. Now, let me show you the software update that made managing a multinational corporation possible in a world without computers. It's called double-entry bookkeeping. Before the Florentines standardized this, business records were a mess of narrative accounting. A merchant would essentially write a diary entry. Today, I lent Giovanni 50 gold coins, and hopefully he pays me back. If you are running a monolithic conglomerate with branches in London, Bruges, Avignon, and Milan, handling deposits from the Vatican and making loans to the King of Naples, narrative accounting is a death sentence. You have no way to track liquidity. You go bankrupt and you don't even know why until the sheriff knocks on the door. The Florentine solution was a mathematical identity that changed the perception of reality. Assets equal liabilities plus equity. Every transaction must be recorded twice. If you move gold, asset, out of the vault to pay a debt, you decrease your cash, credit, and decrease your liability, debit. The books must always balance to zero. While the Franciscan friar Luca Pacioli gets the credit for writing the textbook on this in 1494, Summa de Arithmetica, he was merely documenting what Florentine bankers like the Medici and the Datini families had been doing secretly for centuries. They developed the bilancio, balance sheet, and the profit and loss statement. Why does this matter? Because for the first time in history, a business owner could mathematically distinguish between capital expenditure, building a warehouse, and operating expense, paying wages. When 18th century industrialists like Josiah Wedgwood later adopted this system, it allowed them to discover the economics of mass production. It allowed them to calculate unit economics. You cannot have modern capitalism without this framework. Your chief financial officer, your SAP ERP system, and the transparency of a public blockchain ledger are all descendants of a Florentine wool merchant trying to figure out if the shipment he sent to Belgium 3 months ago was actually profitable, or if he was just churning cash. It transformed business from a superstitious gamble into a deterministic science. Innovation 2. The Protocol of Trust. The Gold Florin. But the most sophisticated accounting system in the world is useless if the underlying unit of account, the money itself, is corrupt. This brings us to the year 1252, a timestamp as important as the invention of the printing press. Florence mints the Fiorino d'Oro, the Gold Florin. This wasn't just a coin, it was a promise. The specs. Exactly 3.53 grams of 24-karat, 99.9% pure gold. The streak. From 1252 until 1533, nearly 300 years, the Florentine mint never debased this coin. Think about the discipline required for that. Kings across Europe were constantly shaving edges off their coins or mixing in copper to fund their wars, essentially creating inflation. Florence refused. They understood that their primary export wasn't wool, it was trust. The image of St. John the Baptist stamped on the coin became the medieval equivalent of the VeriSign SSL certificate, or the full faith and credit of the U.S. Treasury. By 1300, the florin became the international reserve currency of the known world. Merchants from the Baltic Sea to the Nile Delta accepted it without question. Because the standard was so high, over 150 other European states and kingdoms eventually tried to copy it. The Hungarian forint, the Dutch guilder, the Venetian ducat, they were all altcoins trying to fork the Florentine code. This dominance gave Florence a massive economic advantage known as seigniorage. Foreign merchants would haul raw gold bullion to the Florentine mint just to have it struck into florins, paying a hefty fee for the privilege of branding their metal with Florentine credibility. It is the exact same mechanism that allows the United States to export inflation today. The world needs dollars. The medieval world needed florins. Innovation 3. Teleporting capital. The bill of exchange. However, having a stable gold coin creates a physical problem. Gold is heavy, and the roads of 14th century Europe were essentially open-air hunting grounds for bandits. If you are a merchant traveling from Florence to London with 1,000 florins in saddlebags, the statistical probability of you arriving with that money is near zero. The transaction cost of robbery was 100%. The Florentine solution was the lettera di cambio, the bill of exchange. This is the ancestor of the wire transfer and the SWIFT network. Here is the mechanism. You are a merchant in Florence. You deposit 1,000 florins at the Medici bank branch in Florence. The bank gives you a notarized piece of parchment, the bill. You travel to London carrying only this paper. Or, better yet, you send the paper via a courier network. When the paper arrives in London, the recipient presents it to the Medici branch in London. The London branch pays out the equivalent value in English pounds sterling. The gold never moved. The value teleported across the continent, settled via the bank's internal ledger. But here is the genius part. The dark pattern of the system. The Catholic Church strictly forbade usury, charging interest on loans. It was a mortal sin. So how did the banks make money? They hid the interest in the exchange rate spread. The bank would quote a rate for florins in Florence and a different rate for pounds in London. The difference between those rates, the spread, effectively amounted to an annualized interest rate of 15% to 25%. They weren't lending money, they were exchanging currency. This semantic loophole built the cathedrals of Tuscany. This is the birth of the Forex market. It is the exact same principle used by modern payment processors who claim zero fees but give you a terrible exchange rate. Innovation 4. The corporate firewall, the holding company. Now we have to talk about risk management. In the early 1300s, the dominant banks were the Bardi and the Peruzzi families. They were giants, but they organized themselves as centralized partnerships. It was a monolithic structure. The branch in Naples, the branch in London, and the HQ in Florence were all one legal entity. This was a fatal architectural flaw. It meant that if a branch manager in London made a bad loan to a king, the losses were legally binding on the vault in Florence. The contagion risk was absolute. The Medici family, rising later, analyzed this failure and invented the accomandita, the holding company. The Medici Bank was not one bank. It was a federation of independent partnerships. The Medici Bank of Venice was a separate legal company. The Medici Bank of Bruges was a separate legal company. The Medici family in Florence held the majority stock in each, but the liabilities were firewalled. If the Bruges branch collapsed, the creditors could seize the assets in Bruges, but they couldn't touch the capital in Rome or Florence. Furthermore, the branch managers weren't just employees collecting a salary. They were junior partners. They had to invest their own capital into the branch. The manager of the Bruges branch in 1455, for instance, put up 1,000 florins of his own money. If the branch failed, he was ruined first. This aligned incentives perfectly. It prevented principal-agent problems. A manager wouldn't take a bribe to make a bad loan because it was his money on the line. This is the modern multinational corporate structure. Decentralized subsidiaries, local autonomy, centralized strategic control, limited liability. The crash, the systemic reset of 1343. But even the most robust systems hit a breaking point. We need to dissect the Great Crash of 1343 to understand why Silicon Valley Bank, or Lehman Brothers, happens. The history books usually tell a simple story. King Edward III of England wanted to conquer France, the 100 Years' War. He borrowed astronomical sums from the Florentine banks, 900,000 florins from the Bardi and 600,000 from the Peruzzi. Then, he defaulted. He simply refused to pay. The banks collapsed. That is the headline version. The structural reality is far more interesting and relevant. The banks didn't fail just because of the king. They failed because of over-leverage and interconnectedness. The Bardi and Peruzzi had leveraged their deposits to lend far more than they held in reserve. When the king defaulted, it triggered a liquidity crisis. But because they were centralized monoliths, as we discussed, the panic spread instantly. Depositors in Florence heard rumors of the default in London and initiated a bank run. The banks had no circuit breakers. Furthermore, the geopolitical environment had turned toxic. The trade fairs in France, which acted as the clearinghouses for European debt, were declining due to war. The velocity of money slowed down. The data from the Arte del Cambio, the Bankers Guild, paints a grim picture of systemic contraction. In 1399, there were 71 banks in Florence. By 1460, only 33 remained. This wasn't just a recession, it was an extinction event. But here is the lesson for the modern strategist. Crises do not destroy capitalism, they force it to evolve. The monolithic dinosaurs, Bardi and Peruzzi, died, clearing the ecosystem for the agile, decentralized mammals, the Medici, to take over. The Black Death, the economics of the apocalypse. Then nature dropped the hammer. 1348. The Yersinia pestis bacterium enters Tuscany. The Black Death was a humanitarian nightmare, killing 55% of the population in barely a decade. Florence shrank from 120,000 to 50,000. But the economic paradox of the plague is something that defies intuition. In the immediate aftermath, the value of a human being skyrocketed. Why? Scarcity. With half the workforce dead, the surviving peasants and wool workers suddenly held all the leverage. You couldn't just replace a skilled weaver anymore. Wages exploded. In England, reaping wages jumped 67%. In Florence, real wages for unskilled labor rose between 20% and 40%. The surviving workers could demand better food, better hours, and freedom from feudal restrictions. This led to the Ciompi Revolt of 1378, perhaps the first proletarian revolution in history. However, the macroeconomy exacted a brutal price. Stagflation. Production collapsed, fewer workers, but the amount of gold and silver coin in circulation remained roughly the same. Equation: same money supply divided by fewer goods equals massive inflation. The nominal wage gains were largely eaten up by the rising cost of bread and rent. So, how did the Florentine business elite survive? They pivoted. The market for cheap, mass-market wool collapsed. The peasants were dead. So, the merchant families shifted their capital into ultra-luxury goods, silk, brocades, and high-end art. They targeted the survivors who had inherited the wealth of their deceased relatives. The per capita wealth of the survivors was higher. Florence moved up the value chain. Production volumes dropped by 87%, from 75,000 bolts to 9,500. But the profit margins on the remaining production soared. When the mass market dies, the smart money retreats to the luxury fortress. We see this today. As the middle class shrinks, companies focus on premiumization. Innovation 5. Pricing the future. Actuarial insurance. Finally, we look at the invention that allowed merchants to sleep at night: insurance. The Mediterranean sea trade was high-stakes gambling. Storms were a risk, but the real threat was human risk. Corsairs, pirates, and state-sponsored privateers. If you sent a ship from Pisa to Barcelona, you were flipping a coin. Around the mid-14th century, Florentine and Genoese merchants invented the premium-based insurance contract. But this wasn't just gambling, it was data science. They began to price risk based on the route. A ship hugging the safe coast of southern France? Low premium, safe. A ship cutting across open water near the Barbary coast? High premium, high risk. This implies that they had collected massive data sets. They had actuarial tables in their heads, mental spreadsheets of shipwrecks and captures. Wealthy merchants began to pool these risks. They would underwrite, literally writing their names under the contract, small portions of dozens of different voyages. Instead of risking 1,000 florins on one ship, they risked 10 florins on 100 ships. They profited from the spread between the premiums collected and the claims paid out. This democratized trade. A smaller merchant with less capital could now enter the market because he could cap his downside. It is the exact logic of modern derivatives, reinsurance markets, and supply chain hedging. They realized 700 years ago that you cannot eliminate disaster, but you can financialize it. Conclusion: the architecture of now. Let's zoom out and look at the full picture. Florence in 1300 didn't just sell wool. They wrote the source code for the global operating system we live in today. Decentralized supply chains, separating design from manufacturing, coordinated by data. Double-entry bookkeeping, the ledger of truth that makes capital flows visible. Trustless currency, the florin, a standard that allowed strangers to trade without a central arbiter. The holding company, corporate structures that compartmentalize risk to prevent systemic failure. Derivatives and insurance, separation of physical risk from financial exposure. Look at the tech headlines today. Crypto advocates talk about DeFi and trustless money. That is just the gold florin and the bill of exchange digitally remastered. Supply chain managers talk about resilience and redundancy. That is the hard-learned lesson of the 1340s crash. Corporate boards talk about unit economics. That is just Luca Pacioli's ledger applied to SaaS metrics. We are watching the same movie. The Florentine system survived plagues, banking collapses, labor revolts, and wars because it was structurally adaptable. It evolved from monolithic fragility to decentralized resilience. The question for you is not whether the system will break again. It absolutely will. The math makes it inevitable. The question is, how is your personal economy structured? Are you built like the Bardi Bank, centralized, over-leveraged, and exposed to a single point of failure? Or are you built like the Medici, diversified, firewalled, and ready to pivot when the landscape shifts? History has already run the simulation. The results are in the archives. You just have to read them. If this forensic breakdown gave you a new lens on the market, hit subscribe. I dissect the history of money so you can spot the future of wealth. Drop a comment below. Are you team hard money, the florin, or team ledger, the accounting? I read every single one. The pattern is recursive. The algorithm is running. Be ready.